82% of professional fund managers in Australia underperform the market every single year, and you're probably paying for that disappointment right now. Look, if you've got money in super, a managed fund, or any portfolio your bank put you into, there's a very real chance you're paying fees that are eating $400 to $800 per month in returns you're never going to see. Not because you're bad at investing, because the person managing your money is actually worse at it than a computer algorithm. The maths is genuinely insane when you start looking at the Australian data, and I'm going to show you exactly what it costs you, how it compounds against you for decades, and the one decision that takes about 5 minutes to fix. Here's what's actually happening. You've got two types of funds. Active funds, where a professional manager charges you 1.5% to 2% per year and tries to pick winning stocks. And index funds, which charge you 0.15% to 0.35% per year and just track what the whole market does. Simple difference. Absolutely massive impact on your money. 3 quick questions. Do you know what fee you're actually paying on your super right now? Can you name the fund manager handling your money? And have you compared that fund's returns against an index fund doing the same thing? If you answered no to any of those, you're in the exact position where this is going to hit you hardest. Here's the data. Vanguard analyzed 20 years of Australian fund performance. 82% of active fund managers in Australia failed to beat a simple index fund after fees. Not just some years, most years. Consistently, every single decade. Over 20 years, the average Australian investor holding active funds lost $47,000 in foregone returns compared to someone who just put money into a cheap index fund and done nothing. $47,000. That's not a typo. That's the gap between what you're actually earning and what you could be earning if you weren't paying someone who's basically bad at their job. Let me break down what this actually costs you per month. The average active fund charges 1.75% per year in management fees. The average index fund charges 0.25% per year. That's a 1.5% difference. On a $150,000 super balance, which honestly is pretty typical for someone 30 to 40 years old, that 1.5% difference is $2,250 per year. That's $188 per month going to your fund manager for underperformance. But here's the thing that actually matters. That $188 per month compounds at 7% annual returns, which is roughly what the Australian share market has averaged long-term. That $188 per month over 20 years becomes $64,000. Not $188 times 240 months. $64,000 because of compound growth. Your money makes money that makes money. Strategy 1. Check what fee you're actually paying right now. Log into your super or investment account. Find the product disclosure statement or annual report. Look for management fee or expense ratio. Write that number down. Most people never do this. They literally have no idea. And if you find out you're paying more than 0.5% per year on an Australian share fund, you're paying tax for underperformance. That needs to change today. Strategy 2. Switch to an index fund if your fund is underperforming. The maths here is almost stupid in how simple it is. Say you're in an active fund charging 1.7% and it's returning 6.5% per year after fees. Switch to an index fund charging 0.3% that returns 7.2% per year. You just created an extra 0.7% return per year. On $200,000, that's $1,400 per year. $1,400 per year, forever. At 7% growth, that compounds to $35,000 over 15 years. And honestly, most index funds are easier to access now than they were 5 years ago. Strategy 3. Stop looking at 1-year performance and start looking at 10-year performance. Active fund managers will always show you their best years. Look at 2020, we crushed it. Look at 2022, we were brilliant. But zoom out, give it perspective. Over 10 years, the gap between active and index widens. The Vanguard data I mentioned shows 84% of active managers underperform over 10 years. That's worse than over 5 years. That trend keeps going. 20 years, 86% underperform. The longer the time horizon, the more active management fails you. Here's the compound projection, and this is where it actually gets real. You're 35 years old. You've got $180,000 in super. You're contributing $300 per month, which is a pretty reasonable amount. You've got 30 years until retirement. If you stay in an active fund charging 1.75% that returns 5.5% per year after fees, you'll have $1,240,000 at 65. If you switch to an index fund charging 0.3% that returns 7.2% per year, you'll have $1,820,000 at 65. That's a difference of $580,000, not thousand. $580,000. Same person, same contributions, same time frame, different fee structure, different outcome. Actually, before I move on, let me show you something else. If you're already 45, same scenario but 20 years instead of 30, active fund path gets you $520,000. Index fund gets you $660,000. Still, a $140,000 difference. Even with less time it matters. Time amplifies fees, but fees matter immediately. The reason this happens is pure mathematics. When a fund manager underperforms by 1.5% per year, that's not just a loss this year. It's a loss you could have compounded every single year for the rest of your life. Miss out on 1% extra growth this year. You miss out on 1% of that growth plus all the compound growth that would have happened next year, and the year after that, and the year after that. You know what most people do when they see this data? Nothing. They know, they see the number, and they do absolutely nothing. And their bank is actually counting on that, because inertia is free marketing for active funds. Your first step today, right now, is not to switch funds yet. It's to find out what you're actually paying. Most people don't even know. Spend 15 minutes logging into your super account. Find that management fee, then find one index fund from a provider you trust, usually Vanguard or iShares or VAS if you want Australian shares specifically. VAS charges 0.8% per year, 0.08%. Compare that to what you're paying now. The gap between those two numbers is what it's costing you. Make that comparison visible. Write it down. Put it somewhere you'll see it. Then watch one more time how this compounds. Because once you see your actual fee versus an index fund fee, and then you see what that gap becomes over 20 years, switching stops being optional and becomes the obvious move. That's it. Check your fee, compare it, calculate the gap over your time horizon, and then make the call. Your future self is literally waiting for you to do this.